Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing AT&T stock by analyzing their financial statements and dissecting their financial ratios so we can determine if to buy or sell. AT&T is the world's largest telecommunications company and the second largest provider of mobile telephone services. The company began its history as the American District Telegraph Company, formed in St. Louis in 1878. It launched as an independent company in 1983 when U.S. regulators forced the breakup of the Bell system monopoly. It spun off its subsidiaries into regional carriers. 3 years ago, the company paid $102 billion for Time Warner. It recently announced it plans to sell Time Warner for $43 billion to Discovery. This transaction was set up as a reverse Morris Trust, which allows a company to spin off and sell assets while avoiding taxes. The $43 billion will be used to pay down debt, and it will save AT&T $2 to $3 billion per year in interest payments. Also, when the deal goes through, the company will cut its dividend probably in half. AT&T said the main reason for the divestiture is to become a pure-play communications company similar to Verizon and T-Mobile. In 2020, the company's EBITDA margins for the communications business was 35%. That's compared to 29% for its Warner Brothers division. The communications business is a little more profitable, but not by that much. EBITDA margin is EBITDA divided by revenue. The company is headquartered in Dallas, Texas, and was founded in 1983. It started trading in 1983 and can be found on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Xetra, Vienna, Swiss, Colombia, EuroTLX, Sao Paulo, Lima, and Buenos Aires Stock Exchange. Let's get started with the model. This is a large cap company, 191 billion market cap. They're trading at $27 a share, and they have 7.1 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they have tons of free cash flow, 23 billion up to 29 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was really high in 18 and 19, but a big negative in 2020 and the trailing 12 months due to the write-off of their Warner Brothers division. Revenue is a sales for the company, and they have tons of revenue. It peaked in 2019 at 181 billion, now it's 176 billion. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their 2020 revenue by country. A bulk of their revenue is in the US. Europe is 5.4 billion, then Mexico, Brazil, 2.7 billion in all other Latin American countries, 2.3 billion in Asia, and 800 million in other. Here's a breakdown of their 2020 revenue, also with their EBITDA. So their communications revenue is staying, that's 139 billion. They're selling off Time Warner, that's 30.4 billion. That includes 12.6 billion from Turner Broadcasting, HBO 6.8 billion, Warner Brothers 12.1 billion. This is how I calculated the EBITDA margins I referenced earlier. I just took their EBITDA over their revenue. They also have 6 billion of revenue in their Latin America division. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That's pretty consistent each year. It did peak in 2019 at 97 billion. Below that is their operating expenses and then their operating income. They pay 7.4 billion of interest on their debt, which is a huge amount of interest to pay. But as long as they can cover their interest payments, and they can cover it nearly 4 times with their operating income, then it's not that bad. And this is why they have negative net income in the trailing 12 months and 2020, was this big negative in other income and expenses. They did have a big positive in 2018 and 19. Here's a breakdown of all their expenses, excluding the interest expense. They spent $20 billion on equipment, $27 billion in broadcast programming and operations, $32 billion in other expenses. SG&A is $38 billion. They buy a lot of fixed assets, so they had $28 billion of depreciation and amortization. This is a non-cash item, so it doesn't affect your cash flow. The reason they had such a big loss was due to this large asset impairment. That's almost entirely due to the write-down of their Warner Brothers division. Since they paid $102 billion for that division and they're selling it for $43 billion, they had to reduce the value of that asset on the balance sheet and pass through a loss onto the income statement. This is a non-cash item, so it doesn't affect cash flow. When they acquired Time Warner, that's when the cash left the door. Anytime you do a write-down, it doesn't affect cash in that time period. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you should really focus on operating cash flow. Net income can be a little deceiving and confusing. When you want to buy a business or analyze a business, follow the cash flow. They generate a ton of cash flow, over $40 billion a year, and it was close to $50 billion in 2019. They spend a lot of money in CapEx, $14 billion up to $21 billion. And this is from their 10K. The vast majority of our CapEx are spent on our networks, including product development and related support systems. Investing in CapEx is a good thing as long as you have the money, because you need to continuously grow your company, especially when you're this size. Operating cash flow minus CapEx gives you your free cash flow. Look how much free cash flow is remaining after running their business and investing back into it. That's why they pay such a nice dividend. They have so much free cash flow. And they are trying to pay down debt. You can see they issued $47 billion in 2018, paid down $56 billion. So they reduced their debt load $9 billion in 2018. They reduced it $13 billion in 2019, $8 billion in 2020. But they did add $9 billion in the trailing 12 months. A big reason the stock isn't higher, like $70, $80, $90, $100, is because they have so much debt. People are concerned about that. And you can see they add capital stock, $10 billion in 2019, $6 billion in 2020, but they also buy back stock as well. The reason a company with so much free cash flow would add all this capital stock is to usually pay down debt, which it looks like they did, or possibly to acquire another company. This is the equity section of the balance sheet. They have $162 billion of equity. They raised $130 billion from selling their business, and they profited nearly $39 billion from running their business. They also bought back $17 billion of stock. When a company buys its stock off the open market, it takes it out of circulation and puts it onto the balance sheet as treasury stock. So it decreases the shares outstanding in the market, making your shares more valuable. But it's reported in the equity section of the balance sheet as treasury stock, which is a contra equity account. When a company buys back stock, it does decrease its equity. It brought it down $17 billion because it had to use $17 billion of cash to buy back that stock. If the company never paid a dividend, it would probably have well over $100 billion of retained earnings, because retained earnings is a sum of all your prior net incomes minus the sum of all the dividends you paid out. Let's look at the capital structure. $162 billion of equity, $201 billion of debt. They're 45% equity, 55% debt. Here's a list of the companies with the most debt in the world, and AT&T is number one by a decent amount. This just shows us long-term debt. My total debt number is long-term and short-term. So AT&T has the most debt of any company in the world. Then Ford, then AT&T's competitor Verizon, and I was surprised to see Apple on this list. But as a percent of their market cap, their debt is much smaller than any other company on this list. Simply Wall Street has their WACC at 5.5%. Finbox has 6.5%, 7%, and 7.5%. I took the highest WACC from Finbox. I thought the company was a little more riskier now that it's getting rid of its Warner Brothers division. It's a lot less revenue coming in. That's why I gave the highest WACC, to be more conservative. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $442 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $408 billion. We divide that by 7.1 billion shares. And we get a calculated stock price of $57. They're trading at $27, so they're trading at a 53% discount. It's a strong buy according to the model. The average analyst projects their revenue to decrease 1.4%. To calculate their 2021 revenue, I decreased it 1.4% from the trailing 12 months. To calculate 2022, I reduced their 2021 revenue by their Warner Brothers revenue from 2020. Their 2020 Warner Brothers revenue was $30 billion. Since they're not going to have that part of the business anymore, I had to reduce that revenue off of 2022. Then I decreased their revenue 1.4% until 2024. To calculate my terminal value, I increased their revenue 2.5% because I think they should be pretty stable and growing at that point. And even with all these conservative estimates, I'm still coming out with a stock price a lot higher than they're trading at. To calculate their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers, and that's about 15%. So I multiplied their revenue by 15% to get their future free cash flows. Simply, Wall Street is a lot higher than me. Their valuation is $93 a share. 10 analysts priced this stock and the average price target was $31. This is where the stock has been trading the past 12 months. So the stock is trading where it was 12 months ago. But you could see the stock price got a lot higher. Then when they announced the Time Warner sell-off and also the plan to cut future dividends, the stock really came down, and it kept coming down after that. The word on the street is the stock should come down to the low 20s, maybe $22, $23. So that should be a good time to get the stock. So I probably wouldn't buy it now. Of course, it could come down a lot lower than that, or it could never come down to that price point. Nobody can really predict this stuff. A big reason people buy this stock is for the nice dividend. It's nearly 8%. We can't look at the payout ratio since they have negative net income from that big write-off. But they pay out 52% of their free cash flow, so they have 48% remaining, so they could pay a bigger dividend, or they could use that money to pay down debt. Their industry pays a 6.2% dividend, so they're higher than their industry. Analysts are forecasting their dividend to decrease to 7.3%. But once they complete the sale of Time Warner, the dividend should come down to 4 to 5%. The company's beta is below 1, so the stock is less volatile than the market. It's gone down 5% in the past 52 weeks, but if you add the dividend, it's actually gone up. While the S&P went up 24% in the same time frame, the 52-week low was 26, the high was 34, and the stock is trading below its 50-day and 200-day moving average. Lots of people buy and sell this stock. Over 40 million shares were traded on average the past 10 days. Almost all the shares outstanding are on float. Half the shares are held by institutions and 1.5% of the shares are shorted. Analysts are projecting their earnings to grow 13%, a lot more than its industry, but the projection is for their revenue to decline 1.5%. They employ nearly 250,000 people. Their employee count is pretty similar to what it was in 2015. It has gone up and down, but it's been pretty steady. If you invested $10,000 in this company 10 years ago and reinvested the dividends, you'd have $16,000 today. That's only a 5% annual return. The biggest shareholder is Vanguard at 8%, then BlackRock, State Street, Newport, and then Geode. Let's look at their financial ratios. We can't look at the PE since they have negative net income. I recalculated their net income by stripping out the impairment and then recalculating their taxes. And their net income would be $13.3 billion. That would give them a PE of 14.4, which is really good. They also have a really good price to sales of 1.1 and a good price to book of 1.2. Price to book is stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. And the way you calculate equity, you just look on the balance sheet, it's assets minus liabilities. And they have $162 billion of equity, negative $132 billion of tangible equity, since they have over $290 billion of intangible assets on their balance sheet. Their return on invested capital is 6%. That's a little low, but I expect it to get a lot higher as they're focusing more on their higher margin communications business. They can cover their interest payments almost 4 times. They have a negative ROE since they have negative net income. And they have a current ratio of 0.8 and a quick ratio of 0.7. They always seem to have a current ratio below 1. That's not a problem. I don't think there's much risk about AT&T not being able to afford its current liabilities. They have plenty of access to liquidity. They have tons of free cash flow rolling in from their business, or they can issue debt or equity as well. They have $12 billion of cash on their balance sheet, $16 billion of receivables, and $32 billion of prepaid assets. So they do seem to be undercapitalized. They generated $29 billion of free cash flow in the trailing 12 months. They have negative $19 billion of working capital. Working capital is current assets minus current liabilities. And they paid out $15 billion in dividend payments, so they're short $5.3 billion. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 14 companies in the same industry as AT&T. And if AT&T has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. We can't look at the PE since they have negative net income. But if we do strip out the asset impairment, their PE is much better than average. And their price to sales and price to book are also much better than average. And you can see a lot of companies in this industry have a current ratio below 1. T-Mobile is 0.7 and Verizon is 0.8. They have negative ROE. As a percent, they're about average in debt at 55%. Average is 51%. And they're the second biggest company on this list. Verizon is number 1. And they pay a really nice dividend, much higher than average. So to summarize, I have them trading at a 53% discount. And this is one of those companies that is too big to fail. It's such an important company to the United States. Plus, when a company has so much debt, you can't let them go bankrupt, because if they go bankrupt, lots of companies they owe money to may also go bankrupt if they don't receive payment from AT&T. I don't own any AT&T, but I would be frustrated with all of management's blunders. The fact that they lost so much money from buying and selling Time Warner could be a little annoying for an investor. But they're still a pretty powerful company bringing in lots of cash flow, so obviously it didn't hurt them that much. I know they said they plan to cut the dividend in half, but their yield will not be cut in half because their stock price should come down a lot. I ranked their free cash flows and revenue 8 out of 10. Their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.